Hello, everyone. Welcome back to the channel. Matt with Green Bar Trading, and welcome back to another weekly watch list video. I'm going to go over everything that we need to know for the week ahead. Before I do, hit the thumbs up for the video. If you're new, subscribe. And let's get right into it because this is a huge week with earnings. So this is our economic calendar for the week. Nothing going on here. We have the beige book at 2 p.m. on Wednesday. Outside of that, there's really nothing on the economic calendar, which is a beautiful thing because we've been hit with so much macro data and so much algorithms just whipping the market all over the place. It's going to be nice to have earnings do that. So looking at the earnings for the week, we really get into full throttle. You can see here, this is what's going to dictate the market for the next couple of weeks. We're going to want to hear what companies have to say about guidance. So there's so much negative sentiment going into earnings season. If you get even just a little bit of good news out of any companies, you can see them really make a move. So, keep that on watch. You have Bank of America opening us off on Monday before the open. Tuesday, Netflix. Wednesday, Tesla. Thursday, Snap. A lot of these stocks, and obviously I'm not going to name them all, but a lot of them are going to dictate the moves in the overall markets, the ETFs that we trade. So, be aware of that. But yeah, earnings season's getting going this week. So we have the economic calendar, the earnings. These are all things that we need to know. And then this is the 10-year Treasury yield. The beginning of the year, this was trading at just about 1.5. All right. 1.5% at the beginning of the year, Fed tightening, policy, rates rising. Now we're at over 4%. That's a monster move. And in this time, the NASDAQ, the S&P has gone the complete opposite way. So this is in direct inverse correlation with the market. So you want to know, when bond yields are rising, your NASDAQ stocks, your tech stocks, those are not going to do well in this type of environment. You simply have to wait for the Fed to either start to pause, yields to start to come down a little bit. You want to see these, kind of peak and come down. But in order to do that, we have to see inflation come down. And that hasn't happened yet. That's why we're over 4% on the 10-year. The 2-year is the same thing. It's just a straight line up. And when that happens, the equity market is not the place to put the money. Now, you can say, okay, if we peak here and the Fed does start to pause, the yields will come down and the stock market will finally form a bottom and start to gradually come out of it. So, if you're investing for the long term, great environment. You could get some cheap stocks for really good prices. All right, so that's that. Going into our compass, the SPY, S&P 500 daily chart. This is what we're looking at right here. So you can see here on the CPI day, we actually opened much lower and rallied big time. What did we rally into? This pesky 20 EMA on the daily chart. Had trouble back here getting over it, sold off, came back to it to the penny and sold off. So, keep an eye on this 20 EMA. It's great when, you're over it and you're making higher highs. But when you start to break under it, it's very tough to then get back over it. It takes some time. You can see here back in the June lows, it came up to it just like we did here, right? So we made lows, came up to it, could not quite, get over it, sold back off. You can see here, came back, tried to, hold over it. 2 days again. You get 2 days of holding over it, sold back off. We get up to it here, we sold back off. So this is what the bottoming process looks like, and this is what it looks like we're doing here again. So keep an eye on it. We did make lower lows here, so we did undercut the June lows, but we're still chopping around here. But until we get over this 20 EMA and hold over it for more than a day, then we're going to really just see a lot of this consolidation and a lot of choppiness. These markets right here are very tough to trade. Looking at the weekly chart on the SPY, this is what our candle looked like last week. Last week's candle, we came in on this video and said, this is a very bearish looking candle. We had continuation of that, but actually came back and we closed just above that level 3 weeks ago. So, we're still kind of in that range. We're still over here chopping around. This is not a great looking candle, but it is still holding up. We still haven't seen that really big, huge sell-off with the VIX going over 40. This is what everybody's talking about. But sentiment is very, very low right now. So we'll see what happens on that. But watch that 20 EMA on the daily chart. And, we're so far under the 50 and the 200. Just not a great environment right now. Looking at the Qs, same thing. We're actually under the 200 moving average on the weekly. Not looking great. Under the 50. Looking at it on the weekly, this is just going to be a constant battle against those 10-year treasuries, the yields, the dollar. It's just going to be a very tough environment fighting the Fed. So that's the Qs, just making lower lows, lower highs. The trend is obvious. Don't fight that, right? Looking at the Dow Jones Industrials, this one on the weekly is kind of trying to hold up here. Looking at it on the daily chart, it is really trying here to form a bottom. You can just tell that we're getting these rips up and then this really big bounce at previous closing lows. And now we're at that pre-COVID level, just about to the penny of where we hit highs. And I'll show you guys right here. Right here before COVID, that's where we are just above right now. And that's on the Dow Jones. This is held up a little bit better, but something that's held up even better than any of these other ones is the Russell 2K. This is the small cap index, and this is held up and hasn't undercut its June lows. So this one, to me, if you can find some stocks, some small caps to put some money in, this is the place to look, because it has held up relatively a little bit better than other indexes. So that's the IWM. Something else I wanted to show you guys on our flexible grid right here. This is the dollar index for the year. And let me just move this here. This is the dollar index. This is the NASDAQ. The dollar goes up. This is a safe haven. This goes up when the Fed tightens all around the world. This is what's causing, all that currency issues overseas. When our dollar gets this elevated, it sends other markets into turmoil. So the dollar goes up, our markets go down. The same thing if we look at the treasury yields, the year goes up, our markets go down. So these are things you might want to add to your watch list, TNX and DXY, which is the dollar index. So looking at this, if we go back, these are the ETFs right here. And you can look at every ETF. We're under every important moving average. Just go down the list. Every single ETF is having a very, very tough time. It's very hard to pick specific stocks in a market like this, especially going into earnings season. So that's why I'm just giving you guys a broad layout here of the overall environment and what we're looking at. Consumer discretionary. Now, this one is at this important level. If we go back, look at the 3-year, this is holding up right over COVID lows. Now, what makes up the XLY? If we go into our Discord and look at XLY, just click on that. And this is what stocks make up the XLY. So it's a lot of these: Ford, Tesla, Starbucks, Amazon, the Nikes, the McDonald's, all those huge, huge companies that is holding up. So while I'm over here on our Discord, if you are interested, come on in, join. It's only $99, one-time payment, and you get to join a really good trading community with a lot of knowledge in there. So going back to this XLY, it's still, under key moving averages, but it is at a very interesting spot right here. So I'm going to want to keep an eye on this one. Definitely. I want to see if this breaks or if this holds. So that's XLY. XBI, this is the biotech. We saw a double bottom right back to where we started. This is a very typical type of pattern. XRT, retail, it's just chopping around down there. The semiconductors, that's your NVIDIAs, AMDs. These are all just gotten crushed. The IWM, like we said, is holding up. XLV healthcare. Now, this is something that will hold up much better in this type of environment. So XLV, you want to add to your watch list. This is the healthcare ETF. Healthcare, utilities, energy. These are usually things where consumer staples, these are ones that will usually hold up a little bit better than other ones. Now, the only ETF that's over all its key major moving averages is energy. This has been the trade of the year. This was called out on literally January 1st in here of something that you might want to start to get into the environment that we were about to head into. And it has been and has paid off to be an excellent trade. A lot of other traders have just parked a lot of money into energy. How long does that last? Who knows? XLF, another one that's just chopping around here at the bottom of this trading range. So that's it. Basically, a lot of other stocks here are just not doing well. You could look at Amazon coming back down to support. So this is something I would want to watch. And you can set an alert here. I'm going to set an alert at, let's see, 102. I want to set an alert at 102 if this goes below it. All right, create. So if this goes below 102, I want to know, because this has been support right here all year long. So this could be a nice entrance here coming up. All right, so outside of all that other stuff, it's earnings season. So pay attention to what these CEOs give guidance and say about inflation, about the future, about what they see going into the next quarter. not so much what they've done, but what is coming. That is what really moves these stocks, the guidance. So that's it. Hit the thumbs up for me. I'll see you back on the next one. Take care.